If you own a home in Florida, are planning to buy one, or thinking about selling, the latest numbers are about to shift how you see your next move, because what just came out is rough. New migration data shows a dramatic drop in people moving into Florida from other states. Just a few years ago, hundreds of thousands of Americans were relocating there. Now, that number has fallen sharply to a fraction of what it was. In fact, some smaller states are now attracting more domestic movers than Florida. And this isn't just a statistic, it's hitting the housing market hard. In several Gulf Coast areas like Cape Coral, Punta Gorda, and Sarasota, home values have already dropped between 20 and 30% from their peak. In one case, a condo that was worth over $1 million just a few years ago is now listed for under $250,000. But here's the key point. What you're seeing right now may not be the bottom. It could be the early stage of something bigger. Because right now, three major forces are colliding, and together they're creating serious downward pressure on Florida's housing market. First, the insurance situation has moved beyond being just expensive. It's becoming a deal breaker. In some cases, it's making entire properties difficult or even impossible to sell. Second, major home builders across the country have started revealing what's really happening behind the scenes. In Florida, brand new homes are being discounted heavily, tens of thousands of dollars, just to attract buyers. And third, large institutional investors are beginning to offload properties in Florida at a pace that hasn't been seen in years. As more of that inventory hits the market, it adds even more pressure on prices. All of this is building up at the same time. But to really understand what's going on, you have to start with the foundation. Why people are choosing to leave Florida in the first place. Because once that becomes clear, everything else starts to make sense. Recent data shows that several major counties are seeing significant population losses from domestic migration. Miami-Dade is down by tens of thousands of residents. Broward County has also seen a major decline. And Orange County, home to Orlando, is experiencing similar trends. That shift in population isn't just a number, it's the root of what's happening across the entire housing market right now. Hillsborough County, which includes Tampa, lost nearly 12,000 residents. Palm Beach dropped over 9,000, and Pinellas County lost close to 12,000, one of the highest losses in the entire country, second only to Los Angeles. Now, some people will say, what about international migration? Doesn't that balance things out? For a while, it did. International migration helped offset the number of people leaving Florida, but that safety net is shrinking fast. In just 1 year, the number of international migrants moving into Florida dropped by more than half, and projections show that number could fall even further going forward. Even if Florida captures its typical share, the total won't come close to replacing the people who are leaving, and that's where this becomes a serious problem for the housing market. Florida's entire economy is built around growth. Year after year, a steady stream of new residents fuels demand for homes, apartments, and commercial space. When that flow slows down or reverses, everything connected to it starts to break. Home sales begin to decline. Inventory starts stacking up. Builders struggle to move new properties. Rental units sit empty, and prices begin to slide. There's another factor most people aren't even talking about. A large portion of Florida's construction workforce is made up of foreign-born workers. As immigration policies tighten, that labor force is shrinking. So now you have fewer people building homes at the exact same time demand for those homes is weakening. That's a double impact, and it's hitting the market from both sides. So that's the foundation. Migration is dropping fast.
Now look at what that's doing to prices on the ground. As of early 2026, the average home value in Florida has declined compared to the previous year. And on its own, that might not sound shocking until you compare it to the rest of the country. Nationally, home prices are still rising. Florida is moving in the opposite direction. It's one of the few places where prices are actually falling, while most markets are still climbing. And when you zoom in on specific cities, the trend becomes even clearer. Tampa, for example, is now recorded more than a year straight of annual price declines. Month after month, values have continued to drop. That makes it one of the weakest performing major housing markets in the country right now. And when your major metro like Tampa starts leading in declines, it's usually not an isolated situation. It's a signal of something bigger happening across the state. But Tampa isn't even the hardest hit area in Florida right now. Along the Gulf Coast, the declines are even sharper. Punta Gorda is down nearly 12% compared to last year. Cape Coral and Fort Myers have dropped more than 9%. Sarasota and Bradenton are down around 7.5%. Naples is down close to 6%, and the outlook isn't improving. Some projections show Cape Coral could fall another 10% before the end of the year, making it the only major metro in the country expected to post a double-digit decline. It's already being labeled as one of the weakest housing markets in the U.S., and when you look at the numbers, it's easy to see why. Put that into real dollars for a second. If you bought a home in Cape Coral at the peak for around $436,000, which many buyers did during the pandemic boom, that same home is now worth roughly $379,000. That's a loss of about $57,000. In Northport, prices are sitting about 20% below where they were in mid-2022. The condo market across the state is also under pressure, down nearly 10% over the past year, and even more from the peak. It's the steepest annual decline in that segment since the last major housing downturn. For sellers, the situation is tough. Most homes are now selling below the asking price. Only a small percentage are going above it, and homes are sitting on the market much longer. Statewide, it's taking nearly 2 months on average to get a home under contract. In places like Sarasota, it can take over 3 months. And then there's the foreclosure trend, which is starting to turn in a direction that hasn't been seen in years. Florida has recorded the highest foreclosure rate in the country recently, with month-after-month increases over the past year. In Charlotte County, foreclosure filings have surged dramatically since early 2024, putting it at the top of the list for foreclosure risk nationwide. An economics professor even pointed out that this kind of consistent rise hasn't happened since the last housing crisis. Now, to keep things in perspective, this is not a repeat of 2008. Foreclosure levels are still far below what they were back then. Lending standards today are much stronger. The risky loan practices that fueled the last crash just aren't widespread anymore. But the direction still matters, because another issue is quietly growing beneath the surface: the number of homeowners who owe more than their property is worth. In some parts of Florida, that number is starting to climb. In Lakeland, a noticeable share of homeowners with mortgages are already underwater, and in places like Cape Coral, more than a quarter of recent buyers now owe more on their homes than those homes are worth. And when that number rises, it creates even more pressure on the market, because it limits options, increases financial stress, and adds fuel to the cycle that's already underway. Florida homeowners lost an average of about $37,000 in home equity over the past year, the largest drop of any state. Now, if you're in Florida or thinking about moving there, this is where things get even more important, because the next phase of this story comes down to 3 forces that could push the market even lower, and they're already in motion. And this situation is changing fast. Let's keep going. Remember those major home builders? The biggest players in the country have started pulling back the curtain on what's really happening in Florida. One of the largest builders reported a massive drop in profits, cut nearly in half compared to the previous year. Their margins on home sales also shrank significantly, showing just how much pressure they're under. And here's the key detail: they're guiding prices lower. They're expecting to sell homes this year at noticeably reduced prices compared to last year. That's not a small adjustment. That's a clear signal demand isn't where it needs to be. Another top builder is facing the same issue. Their earnings are down sharply, and they're sitting on tens of thousands of unsold homes. That's a huge amount of inventory just sitting there, waiting for buyers. And the reason is simple: buyers are pulling back. Affordability is tight, and people are more cautious about making big financial decisions right now. So what are builders doing to respond? They're getting aggressive. They're offering major discounts, tens of thousands of dollars off new homes. They're cutting prices, covering closing costs, and most importantly, they're lowering mortgage rates through incentives. Some builders are offering interest rates well below what you'd get on the open market.
Others are slashing prices by $30,000, $40,000, even $50,000 just to move inventory. And across the country, a majority of builders are now buying down mortgage rates, bringing effective rates for new construction significantly lower than what typical sellers can offer. Now think about what that means if you're trying to sell your home in Florida. You're not just competing with your neighbor anymore. You're competing with massive companies that have billions of dollars, and they're willing to sacrifice profit margins just to keep sales moving. They can make deals that individual sellers simply can't match, and that shifts the entire playing field. Even with slightly lower interest rates overall, demand hasn't bounced back the way many expected. Builder confidence has stayed below the break-even level for an extended period, which tells you everything you need to know. This isn't a short-term slowdown. It's a market under pressure, and the competition is only getting tougher. In the South, builder confidence dropped deep into negative territory by the end of the year, and by early 2026, more than a third of builders were already cutting prices. In places like Lee County, home to Cape Coral, building permits fell sharply in a single month. That's a clear signal. Builders aren't gearing up for growth, they're pulling back and trying to move what they already have. They see what's coming, and instead of building into strength, they're selling into weakness. Now, let's talk about the insurance situation. This is one of the most overlooked issues right now, but it's causing serious structural damage, especially in the condo market. Home insurance in Florida has become extremely expensive. On average, homeowners are paying well over twice the national average, and over the past 5 years, premiums have surged dramatically. There are a few signs of stabilization. Some new insurers have entered the market. Policy counts in the state-backed system have dropped, and for the first time in years, there's been a slight rate improvement. So yes, there are small positive signs. But when it comes to condos, the situation is much more severe. After a major building collapse a few years ago, new laws were put in place requiring stricter inspections and stronger financial reserves for condo associations, and as of 2026, those rules are fully in effect. Associations can no longer delay or reduce funding for critical repairs and structural maintenance. That sounds like a good thing, and in terms of safety, it is. But financially, it's hitting owners hard. A large percentage of condo owners have already faced special assessments in recent years, and in some cases, those costs are massive, tens or even hundreds of thousands of dollars per unit. On top of that, monthly HOA fees have surged. In some buildings, fees have jumped by hundreds of dollars per month, with total monthly costs now reaching levels that many buyers simply can't afford. And here's where it really starts to break the market. Thousands of condo properties no longer qualify for conventional financing because they don't meet the new requirements. That means buyers can't get standard mortgages on those units. So overnight, the buyer pool shrinks dramatically, often down to cash-only buyers. And when that happens, demand drops fast. At the same time, supply is exploding. Condo inventory across Florida has climbed to more than a year's worth of supply. Listings have surged in a very short period, and nearly half of sellers have already had to cut their prices. When you zoom out, it gets even more clear. Some of the cities with the largest amounts of unsold condo inventory in the entire country are now concentrated in Florida. And that combination, rising costs, shrinking demand, and growing supply, is putting intense pressure on the entire condo market. If you own a condo in a building that hasn't fully funded its structural reserves, you're holding an asset that's losing value, and the number of buyers who can actually purchase it is getting smaller. That's the reality right now. And I know that's a lot to take in, but this is what matters, because all of these pieces are connected. Migration, home prices, builder behavior, insurance costs, foreclosures, they're not separate stories. They all feed into each other. And understanding how they connect is the difference between making a smart move and making a very expensive mistake. Now let's get into the final piece, because this might be the most important signal of all. What the big institutional investors are doing right now. This is where things get very clear. Recent data shows that investor home purchases have dropped sharply in several major Florida markets. Orlando saw one of the biggest declines in the country. Fort Lauderdale and Jacksonville also pulled back significantly. At the same time, more investor-owned homes are being sold at a loss. And these aren't small, inexperienced players. These are large, data-driven companies with teams of analysts, and they're choosing to exit, even if it means taking a hit. But here's the bigger shift. Some of the largest institutional landlords in the country have now been selling more homes than they're buying for over a year straight. Not a few months, over a year and a half. That's a clear change in strategy. In some cases, they're listing thousands of homes, cutting prices aggressively, and making repeated reductions just to move inventory. And Florida, especially markets like Miami and Tampa, is right at the center of it.
Some operators are selling multiple homes for every one they buy. Even companies with large portfolios in Florida are starting to feel the pressure. Rental income growth is slowing. In some areas, it's actually turning negative. Lease rates are dropping, and demand isn't keeping up the way it used to. So from an investor's perspective, the math is changing. If rental income isn't strong and home values are under pressure, the safer move becomes simple. Sell, take the cash, and step back. And here's why this matters so much. When these large investors start unloading thousands of homes into a market that's already dealing with rising inventory, at the same time builders are cutting prices aggressively and condos are sitting unsold for months, it creates a chain reaction. More listings push prices down further. Sellers start competing by lowering prices even more. Appraisals begin to come in lower. Buyers see prices falling and they wait. And that waiting slows the market even more. It becomes a cycle that feeds itself. So what does all of this mean? It depends on where you stand. If you bought your home before the big surge in prices and you're not planning to sell anytime soon, you're likely in a stable position. If you bought before the big run-up and you're holding, you likely still have equity. The key for you isn't the market, it's your costs. Pay close attention to your insurance, and if you own a condo, make sure your building has fully funded reserves. That's where the real risk is right now. Not price swings, but the ongoing expenses tied to the property. If you're trying to sell, especially along the Gulf Coast or in the condo segment, pricing is everything. Most homes are selling below asking. The longer your property sits, the more the surrounding sales start to reset lower, and that works against you. On top of that, you're competing with builders offering incentives and mortgage rate deals that most individual sellers simply can't match. If your home has been on the market for 2 to 3 months without serious movement, it's a strong sign the price doesn't reflect current conditions. If you're a buyer, your window is opening, but it may not be fully here yet. The data suggests prices could continue trending downward through 2026, especially in areas like Cape Coral, Punta Gorda, Sarasota, and Naples. If you're looking to move now, new construction is where the value is shifting. Builders are offering price cuts, closing cost support, and reduced mortgage rates that can bring the effective cost of borrowing significantly lower than what you'll find with most resale homes. That creates a gap, and right now, that gap favors new builds. If you're an investor looking at Florida rentals, there's something important to understand. The largest institutional players in the market, companies with full research teams and long-term strategies, have been selling more properties than they're buying. When those kinds of operators start exiting at scale, it's not random. It's a signal, and it's one worth paying attention to. Here's the bottom line. Florida's housing correction isn't something that might happen. It's already happening. You can see it in the migration numbers. You can see it in builder pricing. You can see it in foreclosure trends. And the 3 biggest forces driving it right now, rising ownership costs, aggressive builder competition, and large investors stepping back, are all still in play. Those forces don't disappear overnight. And that's why the pressure on prices is likely to continue into 2026. Staying informed right now isn't optional, it's critical, because the difference between reacting late and acting early in a market like this can be significant.